monde, je m'appelle Bob Auditor et c'est un plaisir de vous accueillir à cette conférence de presse. Good morning, everyone. Thank you for joining us for today's press conference with Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers. Regretfully, we have had to revert to a virtual format for today's event, but we all remain hopeful that we will be able to welcome you back in person very soon. Governor Macklem and Senior Deputy Governor Rogers will be pleased to take questions for about 30 minutes or so. But before we go to your questions, Governor Macklem will begin with an opening statement. Alors, Monsieur le Gouverneur, à vous la parole.
Thank you, Paul, and good morning. I am very pleased to be here with you to discuss today's policy announcement and our monetary policy report. I'm especially pleased to have Senior Deputy Governor Carolyn Rogers here with me for the first time. She has joined the Governing Council at an important time. Our message today is threefold. Tout d'abord, nos mesures d'urgence pour soutenir l'économie durant la pandémie ne sont plus nécessaires et ont pris fin. Ensuite, les taux d'intérêt vont devoir monter pour contrôler l'inflation. Les Canadiens doivent s'attendre à une suite d'augmentation de taux. Enfin, c'est compliqué de rouvrir l'économie après plusieurs vagues de COVID-19. Mais les Canadiens peuvent être sûrs que la Banque du Canada va contrôler l'inflation et la ramener à la cible. First, the emergency monetary measures needed to support the economy through the pandemic are no longer required, and they have ended. Second, interest rates need to increase to control inflation. Canadians should expect a rising path for interest rates. And third, while reopening an economy after repeated waves of COVID is complicated, Canadians can be confident that the Bank of Canada will control inflation. We are committed to bringing inflation back to target. Let me take each of these in turn. The bank's response to the pandemic has been forceful. Throughout, our actions have been guided by our mandate. We have been resolute and deliberate, communicating clearly with Canadians on our extraordinary measures to support the economy and on the conditions for their exit. When we introduced emergency liquidity measures to support core funding markets, we said they would end when market functioning was restored. And they did. When we launched quantitative easing, we said it would continue until the recovery was well underway. And as the recovery progressed, we began tapering QE and ended it in October. Today marks the final step in exiting from emergency policies. We said exceptional forward guidance would continue until slack was absorbed. With the strength of the recovery through the second half of 2021, the Governing Council now judges this condition has been met. As such, we are removing our commitment to hold our policy rate at its floor of 0.25%. Second, we want to clearly signal that we expect interest rates will need to increase. A lot of factors are contributing to the uncomfortably high inflation we are experiencing today, and many of these are global, and they reflect the unique circumstances of the pandemic. As the pandemic fades, conditions will normalize, and inflation will come down. However, with Canadian labor markets tightening and evidence of capacity pressures increasing, Governing Council expects higher interest rates will be needed to bring inflation back to the 2% target. And finally, Canadians can be assured the Bank of Canada will control inflation. Prices for many goods and services are rising quickly, and this is making it harder for Canadians to make ends meet, particularly those on lower incomes. Prices for food, gasoline, and housing have all risen faster than usual. We expect inflation will remain close to 5% through the first half of 2022 and then move lower. There is some uncertainty about how quickly inflation will come down because we've never experienced a pandemic like this before. But Canadians can be assured that we will use our monetary policy tools to control inflation. Let me now turn to the economic outlook we've outlined in our monetary policy report. À l'échelle mondiale, la reprise est robuste, mais inégale. Les problèmes d'approvisionnement continuent d'être un obstacle. Avec la forte demande de biens et les prix plus élevés de l'énergie, ces problèmes ont fait monter l'inflation mondiale. En réaction, les attentes indiquent maintenant que la détente monétaire pourrait être réduite plus tôt et les conditions financières très accommodantes se sont resserrées. In Canada, growth in the second half of 2021 was even stronger than we had projected, and a wide range of measures now suggest economic slack is absorbed. With the rapid spread of the Omicron variant, first quarter growth is likely to be modest, but we expect the impact on our economy to be less severe than previous waves. We forecast annual economic growth will be 4% this year and about 3.5% in 2023. We're expecting consumer spending on services to rebound and business investment and exports to grow solidly. CPI inflation is currently well above our target range, and our core measures have edged up. Global supply chains, weather-related increases in agricultural prices, and high energy prices have put upward pressure on inflation in Canada, and that is expected to continue in the months ahead. These pressures should ease in the second half of 2022, and inflation should decline relatively quickly to around 3% by the end of the year. Further out, we expect demand will moderate and supply will increase as productivity improves. This will ease price pressures and bring inflation gradually back close to our 2% target over 2023 and 2024. Let me now say a few words about the Governing Council's deliberations. Of course, we discussed the impact of Omicron. Renewed restrictions and household caution about this highly infectious variant have temporarily slowed economic activity. Once again, high-contact service sectors have been hardest hit. But with many more Canadians getting infected in this wave, worker absences have been more widespread. Our high rates of vaccination and adaptability to restrictions should limit the downside risks of this wave. Governing Council also spent considerable time assessing the overall balance of demand and supply in the economy. In October, we projected the output gap would close sometime in the middle quarters of this year. While measuring the output gap is always uncertain, and pandemic-related distortions make assessing supply more complicated, a broad range of indicators clearly suggest economic slack has been absorbed more quickly than expected. Employment is above pre-pandemic levels, businesses are having a hard time filling job openings, and wage increases are picking up. Unevenness across sectors remains, but taking all the evidence together, the Governing Council judges the economy is now operating close to its capacity. We debated the most likely path for inflation. The resolution of global supply bottlenecks has important implications for inflation in Canada. There is some evidence that supply disruptions may have peaked, but the spread of Omicron is a new wild card, and that could further disrupt global supply chains. We also considered the potential for some reversal of the large price increases we've seen for goods. This would put downward pressure on inflation. This would bring inflation down more quickly than we forecast. Overall, we judge that the risks around our inflation projection are reasonably balanced. We also assessed more domestic sources of inflationary pressures. While global goods price inflation is expected to ease, the tightness in Canadian labor markets, rising house prices, and evident capacity pressures suggest that if demand continues to grow faster than supply, this will put upward pressure on inflation. We noted that measures of inflation expectations are broadly in line with our own forecast, with longer-term expectations remaining well anchored on the 2% target. We agreed it is paramount to ensure that higher near-term inflation expectations don't migrate into higher longer-term expectations and become embedded in ongoing inflation. Putting all this together, we concluded that consistent with our forecast, a rising path for interest rates will be required to moderate spending growth and bring inflation back to target. Of course, we discussed when to begin increasing our policy rate. Our approach to monetary policy throughout the pandemic has been deliberate, and we were mindful of the rapid spread of Omicron and the fact that it will dampen spending in the first quarter. So we decided to keep our policy rate unchanged today, to remove our commitment to hold it at its floor, and to signal that rates can be expected to increase going forward. As we indicated in our press release this morning, the timing and pace of those increases will be guided by the bank's commitment to achieving the 2% inflation target. Nos actions ont été bien réfléchies depuis le début de la pandémie. On sait aussi que le variant Omicron va ralentir les dépenses au premier trimestre. C'est pourquoi on a décidé de ne pas changer le taux directeur aujourd'hui, de mettre fin à notre engagement à maintenir le taux directeur à sa valeur plancher et d'indiquer que les taux devraient monter. Comme on a annoncé ce matin, le moment et le rythme des hausses vont être guidés par notre engagement à atteindre la cible d'inflation de 2%. We take our communications with Canadians seriously. For almost 2 years now, we have told Canadians we would keep our policy rate pinned at its floor until slack is absorbed. With it slack absorbed more quickly than expected, it's time to remove our extraordinary forward guidance. This ends our emergency policy settings and signals that interest rates will now be on a rising path. This is a significant shift in monetary policy, and we judge that it is appropriate to move forward in a deliberate series of steps. Let me say a final word about another important monetary policy tool, our balance sheet. The bank will keep its holdings of Government of Canada bonds on its balance sheet roughly constant, at least until we begin to raise the policy interest rate. At that time, we will consider exiting the reinvestment phase and reducing the size of our balance sheet by allowing maturing Government of Canada bonds to roll off. And as we've done in the past, before implementing changes to our balance sheet, we will provide more information on our plans. With that, Senior Deputy Governor Rogers and I will be pleased to take your questions.
Merci beaucoup, Monsieur le Gouverneur. And we will go to questions now. We do have quite a long list of questioners, so I will ask everyone to please limit yourself to a single question so we can get to everybody who is on the list today. And I will also ask everyone to kindly make sure your line is muted. If you're not asking a question, you can do so by pressing *6, and unmute when it's your turn by pressing *6 again. Pour mettre votre ligne en mode discrétion, appuyez sur *6, et pour l'enlever, faites *6 encore une fois. If I fail to identify you when I call on you, please state your name and affiliation. Et bien sûr, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's get started, please, with Julie Gordon from Reuters.
Yes, hello. Hi, Governor. Thanks for taking our questions, and welcome, Senior Deputy Governor. Some economists and members of the business community were surprised by the hold. One even called this a misstep. Can you explain why you decided to wait longer, especially as you're saying slack has been absorbed and inflation will be higher than you previously thought?
Yes, and I'm going to, the Governing Council certainly had a full deliberation, and I'm going to also ask Senior Deputy Governor Rogers to give her perspective. Today, we announced a significant shift in monetary policy. And the short answer to your question, Julie, is that we judged that it was appropriate to move forward in a deliberate series of steps. Today's decision is consistent with our deliberate approach we've taken throughout this pandemic. And it also reflects the fact that Omicron is weighing on the economy as we speak. From the start of this crisis, we've been resolute and deliberate. There's been a lot of uncertainty, and reopening the economy as the variant continues to reverberate through the economy and mutate has proven complicated. By being clear and deliberate, we're really trying to cut through the noise so that monetary policy is more of a source of confidence, and it's not another source of uncertainty. From the start of this pandemic, we've been very clear about the extraordinary measures we're taking to support the economy, and we've also been very clear about the conditions for exit. At the beginning of the crisis, we put in place emergency liquidity, and we indicated we'd remove that when market functioning improved, and we did that. When we launched quantitative easing, we indicated it would be in place until the recovery was well underway. As the recovery progressed, we began tapering QE, and we exited in October. Today, we're exiting the final piece of our extraordinary policy response. We're removing our exceptional forward guidance. We're signaling to Canadians that they can expect a rising path for interest rates. And we're also indicating that once we've increased our policy rate, we will consider shrinking our balance sheet. This is a significant shift in monetary policy, and we judged it was appropriate to move forward in a series of steps. As I said, we're also mindful that Omicron is weighing on the economy, and we are going to learn more about Omicron in the coming weeks. But as I said, Senior Deputy Governor Rogers was also around the table, so let me turn to her for her perspective.
Thanks, Governor, and thanks, Julie, for the welcome. Let me first say how pleased I am to be here and how I look forward to future opportunities like this to speak with you. So, as the Governor said, there was a high level of consensus among the Council on the key indicators. Certainly, there was broad agreement that slacks absorbed, and that led us pretty easily to the decision that emergency measures like forward guidance were not needed anymore, and it was time to remove them. And to the message to Canadians that we need to, that we're on our way to a rising path to interest rates. So those decisions, they were considered carefully, but there was a very high level of consensus. And then, as the Governor said, Omicron weighed on the Council's decision. From an economic perspective, this wave of the virus looks to have less severe economic impacts, owing in part to less severe health impacts. Certainly, this is credit in part to a high vaccination rate in Canada, but also to the adaptability of Canadians and Canadian businesses to the virus so far. Having said that, certainly we've seen an effect on economic activity in the first quarter, employee absenteeism and increased measures, and of course, understandably, consumer caution has weighed on activity. But as we said, we think that that effect will be shorter-lived, and if that proves to be true, we think an economic rebound is around the corner.
Okay, our next questioner will be Greg Quinn of Market News, followed by Paul Vieira from the Wall Street Journal. Greg?
Good morning. The bank's inflation forecast for this year was raised today to 4.2%. In October, it was a prediction of 3.4%. In July, it was 2.4%. What is it that has made inflation so difficult to predict, and what gives you confidence that long-term expectations are going to stay in order?
As I just outlined, much of the inflation we're seeing today really reflects global factors and the unique circumstances of the pandemic. We've seen global supply chains are gummed up. There are all kinds of logistical problems. Combine that with the fact that households being unable to buy a lot of the services they want during the pandemic have shifted to goods. Goods need to be produced, they need to be transported. And given the disruptions in global supply chains, that has all put upward pressure on goods. So, goods prices are rising much faster than normal. And that is largely the reason, together with rising energy prices and more recently rising agricultural prices, is really why inflation is well above our target. In chart 9 in our monetary policy report, we do a good job of decomposing that for you. Why are we confident that inflation is going to come back down? Well, we're starting to see some evidence that these global supply chain issues are starting to get resolved. If you look at shipping costs, if you look at port backlogs, they look to have peaked and in some cases coming down. Omicron is a new wild card. It is reverberating around the world. It could create some new problems. But, as this pandemic recedes, two things should happen. One is households should be shifting away from goods back towards more services. That should relieve some of the demand pressure on goods. And these supply chain disruptions should get resolved and work their way through. We do think that's going to take some time. There are backlogs. And so we do think inflation is going to remain around 5% through the first half of this year. We then think it's going to come down fairly quickly through the second half of the year to about 3% by the end of the year. The other element is, as we've signaled, we expect to be raising interest rates, and that will dampen demand growth and ensure that domestic sources of inflation do not build up and inflation comes back to target.
Thanks. We'll go to Paul Vieira now, followed by Eric Hertzberg of Bloomberg.
Can you hear me?
Yes, very well.
Yes. Okay. Thank you. Governor Macklem, was Omicron the only reason the central bank decided to hold off on raising rates today? Because the outlook, the NPR has a rather bullish outlook on the economy. You said that slack is absorbed, and that there is a risk that higher inflation expectations get embedded into the economy. Can you please answer?
Certainly, Omicron was a factor in our decision. We are mindful that Omicron is weighing on the economy as we speak. We have a pretty modest growth forecast for the first quarter. But as Senior Deputy Governor outlined, we are hopeful that Omicron is fairly short-lived. Certainly, there is some evidence coming out of public health that it may have peaked and is beginning to come down, and we're starting to see some restrictions removed. So we are expecting a fairly good rebound. So look, there is uncertainty about Omicron. We're going to learn more about the path of the virus in the coming weeks. We were mindful of that. But what I would stress really is that we announced a significant shift in monetary policy today. We have removed our exceptional forward guidance. We've signaled clearly to Canadians that they should expect a rising path for interest rates. And we've also indicated that once we raise rates, we will be considering quantitative tightening. That's a big shift. And consistent with our deliberate approach through this pandemic, we judged that it was appropriate to move forward in a series of steps.
Thanks. We'll now go to Eric from Bloomberg, please.
Hey, good afternoon, Governor, and welcome to Senior Deputy Governor. We have inflation here at 30-year high, at a three-decade high, and still rising. Forecasts you released today show slack essentially absorbed, employment near full. Central bank credibility is a delicate thing. I'm just curious whether you could talk a little bit more about whether or not you believe not hiking interest rates in the context negatively impacts the bank's credibility.
I think we've been very clear today that we've announced a significant shift in monetary policy. We have signaled very clearly to Canadians that they should expect a rising path. The time for emergency policy settings is over. That really reflects the fact that, yes, inflation is uncomfortably high. We do expect inflation is going to come down fairly quickly in the second half of this year as the problems in global supply chains get resolved and the pandemic recedes. But we also see that, as you just indicated, slack is absorbed. And that means that we do need to bring demand growth in line with supply, and that requires a rising path for interest rates. When we look at inflation expectations, what we see is that near-term inflation expectations have gone up, and actually those are very consistent with our own forecast. We are expecting inflation to remain around 5% through the first half of this year. But the other thing you see when you look at inflation expectations from surveys, from markets, medium and longer-term inflation expectations remain well anchored on the target. And that, too, I think that reflects the confidence that Canadians have that we will bring inflation back to target. One thing I can tell you about our deliberations was that we all agreed it was paramount that we take action to ensure that this rise in near-term inflation expectations doesn't start to migrate to medium and long-term inflation expectations, because if that happens, it will become embedded in longer-run inflation expectations. And the best way to keep inflation expectations well anchored on our target is to get inflation back to target.
Okay, next on my list, I have Jordan Press of Canadian Press, followed, et ensuite, il y aura une question du TVA. But Jordan first, please.
Good morning, Governor and Senior Deputy Governor. My question has to do with looking at the labor market. In the NPR, while it shows a number of indicators have recovered, there are still quite a few that are still far below the recovery point. And I'm wondering how much that has affected maybe some of the decisions you are going to be making about the path for any rate hikes, and maybe what you want to tell those people who are maybe still long-term unemployed in this country about what your changes in monetary policy may mean for them.
In our report, we have quite an extensive discussion of labor market indicators, and maybe I'll ask Senior Deputy Governor Rogers to say a few words about how that factored into our deliberations.
Yeah, I think your point is a good one. I think if you're employed in the hard-to-distance sector, if you're sitting in a community that's reliant on tourism, it probably doesn't feel like the labor market's fully recovered. But as the governor said, and as you'll see in our report, we look at a broad range of indicators, and overall, what we observe is that employment participation rates are back up to near pre-pandemic levels. There's pressure on wages, and employers are having a hard time hiring employees for a high level of vacancies. So in total, those things say to us that the labor market is tightening and slack is absorbed.
D'accord. Passons maintenant à Olivier Ferron-Boissé du réseau TVA.
Oui, bonjour. J'espère que vous m'entendez bien.
Oui, on vous entend.
Génial. Bon, je comprends que vous annoncez la fin des mesures d'urgence pour soutenir l'économie, qu'on annonce que le taux va monter, mais ne craignez-vous pas que le fait d'attendre encore avant d'augmenter le taux ne fera un peu qu'empirer la situation de l'inflation et que la pente vers l'objectif de 2 soit encore plus difficile à surmonter? Bref, les conséquences d'attendre, est-ce que vous avez une idée de ce que ça représente?
On a c'est aujourd'hui un changement important de direction de politique monétaire. Depuis presque 2 ans maintenant, nous avons indiqué aux Canadiens qu'on va maintenir nos taux d'intérêt à sa valeur plancher. Aujourd'hui, on a enlevé notre indication perspective. On a mis fin à cette indication perspective exceptionnelle et on a indiqué aux Canadiens qu'ils peuvent anticiper des hausses de taux d'intérêt. Et je veux souligner qu'en indiquant qu'on va anticiper les hausses, ce n'est pas une hausse et c'est fini. On indique que probablement il y aura besoin de plusieurs. Ce n'est pas automatique. On va prendre nos décisions pour les taux d'intérêt à chaque réunion du conseil de direction, mais c'est clair que la direction est claire. Et je pense que les Canadiens, on sait bien que les Canadiens sont inquiétants au sujet de l'inflation. Et on veut les rassurer qu'on va retourner l'inflation vers la cible de 2 %.
Et merci. We will go now to Mark Rendell of the Globe and Mail, followed by Michelle Zadikian of BNN. Mark?
Hi there, can you hear me?
Yes, Mark.
Fantastic. Thanks for taking the question, and welcome, Senior Deputy Governor. As you say, we're entering a rate hike cycle. Rates are going to start going up in the next little while. How high do they need to go to get to a point where the bank is no longer stimulating the economy and you're kind of getting back to neutral?
Mark, I think we've really been quite clear today that interest rates, everybody should expect interest rates to be on a rising path. I'm not here to validate the market curve, I'm not here today to tell you, exactly how fast or how far they're going to go up. But, a path does signal a few things. First of all, as I just indicated in French, a path is not one move. A path is a number of steps. Secondly, a path, the path doesn't mean we're on autopilot. It's not automatic. And we will be assessing at each meeting. A path doesn't rule out that you would take a few steps and then we might pause and assess progress. Those are decisions we're going to need to take moving forward. The other thing I'd say about the idea of a path is we are starting from exceptionally low interest rates. And when you start at the effective lower bound and you're indicating a path, the implications for interest rates are pretty straightforward. There needs to be a series of steps. As you get further down that path, the decisions will become more finely balanced, will become more data dependent. I think the message is pretty clear. We're on a rising path. How far and how fast, those are decisions we'll take at each meeting, depending on economic developments, depending on our outlook for inflation, and what we judge is needed to bring inflation back to target.
Thanks. We'll go now to Michelle from BNN, followed by Rule of Epoch Times. Michelle.
Hi there, can you hear me?
Yes, Michelle.
My question is, on BNN, we've had a lot of mortgage experts saying that there's been an increased demand for variable rate mortgages. So some of these borrowers are thinking the bank is not going to hike as much as the market thinks. What would you say to those people?
I'm going to ask Senior Deputy Governor Rogers to take this question.
Yeah, thanks, Michelle. So, as the governor said earlier, we're not in the business of giving financial advice, whether to take a fixed or variable mortgage rate. As it relates to housing, I think our forecast is clear what we see the path for housing to look like. Housing activity has been elevated for a while now in Canada, and housing affordability has been a persistent problem. You can attribute it to a number of things. Certainly low interest rates is one of those factors. A recent spike up in prices has also brought investors into the market, more investors into the market. That's something the bank has published research on recently. Overall, the bank's view is that the most important thing that will restore balance to the housing market in Canada is an increase in supply. Supply has not kept pace with demand, and we think that's an important thing that needs to happen. So we're encouraged by recent conversations in that direction. But overall, coming back to the forecast, we think housing activity will stay elevated for a while. Certainly, our message today that interest rates are on a rising path will feed through to mortgage rates and likely moderate demand over time.
Okay, we'll go to Raul of Epoch Times now, and followed by Craig Lord from Global.
Yes, hello, and good morning. The NPR mentioned the assumption that oil prices remain flat and the boost from higher gas prices should also fade in the coming quarters. And I understand that you hold your oil price projection flat the projection period. But it's been well over $80. Now it's like 86. The projection is 75, what you're using, and some say it could go to 100. What would that do to your inflation forecast? And would the bank need need to get more aggressive with rate hikes? Like, it's not mentioned as a risk factor, but I understand that it is a double-sided risk. Like, is it more tilted up or down in terms of a risk factor?
Well, let me say a couple words about oil prices, and then I'll look. You got to look at the full range of risks. With respect to oil prices, yes, our standard convention is to use a flat profile for oil prices. If you actually look at the futures curve right now, it actually has oil prices coming down a little bit. So in that sense, it's a bit higher than if we'd used the futures curve. Look, there are certainly, we know oil prices can be volatile. So, there are risks on both sides there. When we look at the risks to our inflation forecast overall, yes, there are certainly some upside risks. It could take even longer for these global supply chain issues to get resolved. Oil prices could spike higher. On the other hand, when we've seen in the past, when you've seen big increases in good prices, it's not unusual to see some actual reversal of those prices. If we actually saw a reversal, inflation would come down more quickly. To give you an example, we ran a simulation, a scenario where there's a 30% reversal in global goods prices. That would actually bring inflation down somewhat a little bit below the 2% target next year. When we look at the full range of risks around our inflation forecast, we judge that they are reasonably balanced. Having said that, inflation is uncomfortably high, and so we are more concerned about the upside risks than the downside risks. And we will be using our tools to manage those risks going forward.
Okay, our next questioner is Craig Lord from Global News. Craig, please go ahead.
Good morning. Thanks for taking the questions. I'll actually ask you to maybe expand a bit on what you were just saying there, Governor Macklem. The possible reversal of growth in goods prices that you've listed as uncertainty. Could you explain a little bit about what would cause that, and maybe even how likely a scenario that is looking forward in the few months ahead, that possible phenomenon and its impact on inflation?
Well, we've been faced with a very unique set of circumstances that has put a lot of upward pressure on globally traded goods. It's a combination of a very rapid global recovery from COVID. That's a very good thing. And one of the features of this recovery is because people everywhere in the world can't consume as many services as they want. They can't go to restaurants, so they're buying new equipment for their kitchen. They can't go to the gym, so they're buying home gym equipment. Those goods have to be produced. They need to be shipped, and against a background of an impaired global supply chain that is being affected by COVID, where production is, some production plants have had to close, production has had to be slowed down, transportation gets slowed down. That has all put a lot of upward pressure on goods. As things move forward, we expect a couple of things to happen. As the economy continues to reopen, we expect people to shift away from goods back towards more services, so we think demand for goods will come off. And as these global supply chain issues get resolved, production should come up, logistic problems should work their way through, and there'll be more supply. So in that scenario, it's not hard to imagine that you get actually some reversal of goods prices. We haven't built any reversal of goods prices into our projection. If you were to put them in the projection, inflation would come down faster than we've forecast. We haven't done that because there are also risks on the other side. There is some uncertainty about how quickly these supply issues will get resolved. There is still uncertainty about the course of the virus, or Omicron is reverberating around the world. And as I said earlier, we think we've taken a pretty balanced view with respect to our inflation forecast.
Okay, thank you. We do have time for one more question, and I am going to ask that for Tony Mace of Mace News, please.
Hi, Governor. In the statement today, it says the bank is planning to consider exiting the reinvestment phase once we begin raising rates. Can you tell us how we should be thinking about that process as it relates to interest rates? I mean, is quantitative tightening equivalent to a rate increase or more than one? Thank you.
Okay, a few things on that point. So first of all, what we said today is that once we raise interest rates, we will be considering exiting the reinvestment phase and allowing at least some roll-off of Government of Canada bonds from our balance sheet. At this time, we're not actively considering outright sales of Government of Canada bonds, but once we increase rates, we will be considering allowing Government of Canada bonds to roll off. In other words, not be replaced. And you know, before we implement any changes, we will provide more information on how we would operate should we move forward with that. With respect to how to think about quantitative tightening relative to interest rates, a couple of things. First of all, we've been very clear today telling Canadians that they should expect a rising path for interest rates. And as I've already explained, that's not one move, that's a number of moves. We do view interest rates as our primary monetary policy tool. Our balance sheet, decisions we would take on our balance sheet would supplement that. So hopefully that gives you a clearer picture of how we see it. And with that, I think, thank you very much.
That does, in fact, concludes today's press conference. So thanks very much, Governor Macklem and Senior Deputy Governor Rogers. And thanks to the reporters for participating. And thanks to all of you for watching and listening. À la prochaine.